to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Today, we're unpacking some of the most significant proposed changes to property tax settings in decades, including negative gearing adjustments and the shift in capital gains tax treatment. I'm joined today by accountant and property taxation and investment expert and advisor, Munzurul Khan, who brings a grounded, practical view on what this means for investors, borrowers, and the broader housing market. We walk through who is most impacted, why first-time investors may feel the pressure first, and why more sophisticated investors may actually find opportunity in the change. We also explore the bigger question whether these policies improve affordability or simply shift pressure elsewhere in the system. Let's get into it. Munzurul Khan, thanks for joining me back on Geared for Growth.
Thank you very much. Thank you, Mike. Thank you for having me.
I've probably said this to a couple of guests, but I wish it was under better circumstances. Now, of course, that relates quite heavily to you in your role as an accountant and as an advisor to investors and business owners. How does the average person in the street understand this issue, and how meaningful is it for all the people that you service right now?
Thank you. Thank you, Mike. There's two questions that you asked, is that how meaningful and how does the mum and dad investors and mum and dad taxpayers sort of understand, and see, both when we say meaningful is we have seen some of the changes, Mike, that we haven't seen for years and years through a generation. And it goes back all the way to 1985 and goes back to 1987 when that negative gearing was being taken away and sort of it's being reintroduced in 1987. So it's literally is a change in 40 years, a change through a generation. With that many years of working experience, I still don't have the working experience of last time when we had this same level of the rule, right? So this is sort of how prudent it is. I suppose what does that do in terms of the mum and dad investors side of it? Australia as a nation, we love properties, and we the great Australian dream in terms of having your home and home to sort of pay it off over a period of time is through other investments as such, And if we look through that great dream in terms of the wealth creation in this lucky country as such, is that we say that all of those changes just seems to create so many blocks in terms of that open layer of the competition. So from a mom and dad investors point of view and mom and dad taxpayers point of view, there seems to be a lot of noise. There seems to be quite a bit of confusion, unfortunately. And just before this podcast, we were speaking that some of the explanation of the changes has started to coming through. A bit portion of the legislation has started to coming through, and more we sort of look into some of those legislation, we need to say, well, we need to understand a bit more. And this is coming in from the professional point of view. So then we sort of say is that if someone is sort of not at your level of the experience, not as an accountant, what does that mean from those investors' point of view? A lot of confusion, a lot of uncertainties.
I suppose one of the biggest things for me is just this fundamental idea of the property investor and that they are doing something wrong. They are a problem for the economy. They've certainly been pointed to as a problem for housing affordability and first home ownership. But I would argue that the government is really out of the public housing business, and they've passed the mantle over to property investors to supply rental accommodation. And now we're a little bit in trouble because we've been too good at it. How do you read that?
I sort of say over and over that in the economy, the best way to manage the economy is let the economy to manage by itself. And the economic term behind it is the invisible hand, is to say that you rely on the supply and the demand. And yes, the market will create the anomalies along the way, and those anomalies will be fixed by the market by itself. So you're right. I mean, the regulation is being left quite open, saying that these are the rules, these are the protocols, and you play within that rules and within that protocol. And within that rules and the protocol, there are investors who's become quite sophisticated, and there are investors based on their risk profile that may be a bit more stagnated. It's not right or wrong. It's just two different journey that people have taken it. So I think the challenge with this sort of budget side of it and the question that they sort of raised, it's sort of almost artificially sort of creating that handbrake as opposed to having that open slate of the market. Now, that I personally struggle. I suppose the second thing which I struggle, Mike, as well, is that the legislation is all about the certainty. Yeah, we are rule follower and rule provider, rule follower, the citizen, right? And when this legislation comes in, the question comes in is that, well, what would be the detailed format of the legislation? Are they going to change it over the next 1 year or 2 years' time before they get implemented? What happens if there is a new government coming? Does the new government going to change this? We look into Superfund as an example. We say not many changes. Are we going to have more changes in the future? Those sort of uncertainties, none of those are good for the nation. Why they're not good for the nation? Because from an investor's point of view, it's about the confidence. Yeah, as much as it is confidence on the economy, it's on the confidence on the corporate governance. It's the system, process, and the regulation as such. And if the system, process, and the regulation creates that layer of the uncertainty, there is a genuine economic cost to it. Challenge is that very often it's a soft cost, and we don't get to see that soft cost as such. So, to answer the question, have we become too good to it? I think Australia has been a lucky country, and there's some of those impacts. I don't know whether they're so lucky.
Well, let's split this into two halves. Let's talk about negative gearing first and CGT next, because CGT, you could argue, has bigger implications, way more than property and even economic performance of the entire nation, especially when it comes to investment and people starting businesses. But if we look at negative gearing, the way that I see it right now is that if you're buying any investment property around Australia on a normal loan to value ratio, you are very likely to be negative geared. Now, the legislation says that you can cauterize those losses a little bit like a family trust, and you can get the benefit of that later on. But I always argue the hardest time to hold an investment property is from day one, because over time you may pay down your principal, but rents you could expect to grow over time. So from a cash flow perspective, the beginning is where those deductions are actually quite meaningful, and more meaningful for aspirational people than wealthy people, right? People that have a portfolio already, or they have an income of $1 million a year, don't need that help that negative gearing gives in the beginning. What's your sort of read on it, and do you feel I've got that reasonably right?
I think you've got that absolutely brilliantly right. And the reason I say absolutely brilliantly right is that I can give an analogy as an example, and we go a little bit deeper. I look back into my very first investment property. Yeah, very first investment property I bought all the way back in 1999. And when I bought it back in 1999, I was sort of hardly finished my uni, and I was at first year at sort of work. And my salary back in 1999, I still remember, it was about 36,000. Yeah, and 36,000 was my annualized salary pre-tax. 1999, just completed my graduation. As a graduate, we sort of starting, bought my very first property, and that property was negative gearing at that stage. Yeah, and the rent on that property back in 1999 was $180. If we look back now, the rent of that property right now is sitting about $670. Yeah. So I still own that particular property. So the view is in here is that while we speak about that negative gearing, and the government is sort of saying we want to take away that negative gearing, I suppose a fundamental thing that we're missing is that over the lifespan of that investment property, if we hold it for long enough, the property balances out by itself. So that example that he was sitting about 180 as a rent, now it's sitting about 670 as a rent, assuming my interest and loan still the same, which it isn't, but let's assume that it's still the same, means that it has become significantly positive cash flow now. So in day one, when my salary was about 36,000, I needed that negative gearing to run and manage and maintain this particular property. Now, after about that many years, 27 years or so, is that while the income has been much more blessed, is that one is that I don't need it, but on the other side of the equation, it is such heavily positive cash flow, I'm actually paying tax on that particular property as such. Now, to me, it is the right structure, yeah, for a young lad
Yeah.
and for a young family. You give them that bit of the tax benefit in day one, just to give them a little bit of a start in life, so to speak. But if you just take away that layer of the negative benefit and negative gearing in day one, the impact of this is quite multiplier, Mike. So I absolutely agree.
Yeah, and I suppose that tax concession, if you want to call it that, put you in a position or gave you a bit of a slingshot forward to a point where you're paying an insane amount of tax these days as a
Yeah.
successful investor and business owner, right?
Yes. And this is where you would probably say is that we very often say that we don't do a property investment for tax benefit. We do a property investment for our wealth creation, which I absolutely wholeheartedly take in my heart. And I say, I agree with this. But what I also say as a provision attached to it is that there is a timing difference. Yeah. And the timing difference means that in the early stage, you sort of almost need as many leverage, as many supporting hand to get you started. And once you start with this, perhaps you don't need that much. A similar example I'll utilize is that I've seen many of my clients as the early stage in terms of their LVR, as the leverage side of it, they get quite high on the LVR side of it. They go into the LMI territory, lender's mortgage insurance. But over a period of time, many of those investors, I've seen them, they become a little bit more conservative. They take a bit of a step back and they go back into your traditional 80%, 70%, and 65% as the LVR. So was 90% incorrect or was it 65% incorrect? I think the answer in my mind, both is correct. And based on their circumstances, risk profile, and the timing of it. Yeah. And I suppose what
Yes.
this negative gearing taking away has done is that taken away that one opportunity where an investor say that I choose to be a little bit more assertive, being in a fully informed manner. And I understand I'm relying on the tax benefit for a shorter period of time, but that is to give me a helping hand.
And there's some unintended consequences, like people wanting to rent fest their way to their first home to occupy, that this has created some headwinds for now as well, not just with negative gearing, which with CGT as well, which we'll get back to. But I'm guessing if we're looking at the legislation that's been proposed, the serviceability isn't going to be there. The banks have already said they're not going to consider the negative gearing, so borrowing capacities should be diminished. And there's probably less people that are able to suffer a negatively geared property without that immediate tax benefit. Do you see there likely will be less investor transactions, at least for those beginning investors, rather than the top end of town that maybe already have a positively geared portfolio?
Brilliant question, because the answer would be in my mind is that the answer is yes and both no. And yes, in the sense is that more in terms of the beginning investors, the answer would be unfortunately overwhelmingly yes. However, what that does is that that gives an opportunity for very sophisticated investors. And then we come back to the question that who was being intended to be supported, the beginning or very sophisticated investors. So we'll come back to it in a moment. Yeah. Where we sort of say the answer would be unfortunately yes, that for a beginning investors, it'd be that much harder. Most of the banks, yeah, as of today is that we sort of end of May, and end of May 2026 is that many of the banks have taken away the negative gearing. And the rules are not coming in up until a period of time, 1st of July 2027, right? But the bank has, as a sort of pre-warning, is that they've already started taking away some of this negative gearing in terms of their serviceability. And if we do that, that makes a massive difference. Yeah, I was speaking to different mortgage brokers, and there are some statistics says that on average, whether it takes away about 15% for a investor for one or two properties, and that has got a massive impact. Yeah, for every 0.5% increase of the interest rate, we say that it takes roughly about 5% of the LVR, give or take. And this is why we're sort of saying it's taking about 15%. So it's sort of almost like having 0.5% interest rate being increased three more times on top of the interest rate, which already is very high. So one is that
Yes.
from a bank serviceability point of view, and second is that from even from a cash flows perspective, yeah, that for all of those beginning investors, it is absolutely much harder. Where it is the consequences behind it is that for the sophisticated investors who's got just a little bit more advance in life because of the age, because of the circumstances, because of the good fortune as such, a little bit more advance in life, they've got a bit more, I suppose, the firepower in their hand and a bit more liquidity and a bit more LVR and bit more income as such. They are the one who would be coming in right now within these circumstances, and rather than being concerned, they would be, in my view, it would be looked through and say that this is a moment of opportunity to buy. And I'm dreading is that those level of the investors, their activities will increase quite substantially simply because they can afford to do it. Whereas these are the beginning investors, they would, as much as they wish to do it, is that the option would not be there. So does that mean that the wealthy are becoming a little bit more wealthy and the people who are aspiring to become wealthy, they're becoming just a little bit more challenged? I question.
Yes, it's a big question about the wealth gap, right? Because if you've got an established portfolio, maybe you've got some negatively geared assets, you can carry those into perpetuity. If you've got a little bit more firepower behind you and you don't have a higher leverage, you can take opportunity of, maybe a bit of a downturn that we could see. So it does sort of seem like the wealth gap is getting a little bit wider. And they did talk about other alternatives. In fact, One Nation's now policy is that they would recommend limiting negative gearing to 2 properties, so that kind of removes that issue for the aspirational investor or the first home buyer. And they've said that they fully oppose all of the CGT. And it's an interesting time in Australia when we see One Nation having some of the more sensible policies, I would argue.
I'm very tempted to make a lot of comments and I'm probably going to stay out of it.
It's good. We don't want to get you in any trouble. Let's move on, Munzurul. You can take that one as a comment rather than a question. Let's talk about CGT because, as I prefaced, it's bigger than property. It's a little bit harder to understand. So the headline is really that the 50% CGT exemption dies on 1 July, and then we move into an indexation model, which is, of course, the old model. And you've got to do some calculations to see, well, what sort of interest rate environment are we in? How long do we hold the asset? But I think most commentators have said, well, at the end of the day, this really puts us up there in terms of OECD countries with our rate of capital gains tax, however that modelling comes to bear. What's your read on it?
Yeah. Look, a fundamental tax rule that we have, or protocol, if I may, that we always relied is that everything is a grandfather provision. Yeah, you never penalize a taxpayer of making a decision at a particular point of time when the taxpayer has made that decision on the basis of the tax rule as at that point of time. You can try to change things going forward, but you sort of always grandfather. Now, the definition of the grandfather, there is no sub-grandfathering provision, grandfather or not grandfather. This is sort of a bit of a mix and match in terms of the grandfather provision, right? So the people who sort of owns the property sign the contract unconditionally by 12th of May 2026 at 5 p.m. or earlier means that they fall in on the old rule. And the old rule means that, well, up until June 2027, they can still use the 50% CGT discount. And from 1st of July onward is that it's the indexation method, exactly as you said, yeah? And anyone who's sort of doing it subsequent to it is that they're the one who's sort of utilizing as the indexation method. Now, how do we compare that to the rest of the world, yeah? I think I look back into the tax rate and I say Australia's highest marginal tax rate is 47%, which is one of the highest tax-paying nation in the world. Yes, there are countries which are higher than us, but there are many, many, many countries which are much lower than us. So we ride at that sort of a tip on that highest. And I think that has a strong bearing in terms of this indexation side of it, because you're paying tax at that 47%. We understand it's the real return, which we speak, but that 47 is the one that sort of comes in, which makes our tax just that much higher as such. Yeah. The other comment which I say, Mike, in my view, is that it's also the how the maths work. So we speak about the CPA and we sort of say, what is the CPA? We're looking at the inflation as it now is, it's sitting 4.6%, yeah? And then we sort of say, well, our average is about 2 to 3 is what we aspire to, and hopefully we'll go back into that 2 to 3%. What is it in the longer period of time? So if we sort of say in the longer period of time is 3%, what's the level of the growth that what we are after? Are we having a 7% growth? Are we having a 5% growth on average? Or are we having a 12% growth? Yeah. If I have a 12% growth, is that I'm paying tax of 12 minus 3, which is at 9%. But in the old method is that I was going to pay tax on 12% growth with 50% discount at 6%. So the gap is quite considerably high. But if that level of the growth rather than being 12, it sort of becomes 10 and sort of 7, which are a bit more realistic, is that one sort of says that, well, based on the circumstances. In many of the circumstances, the gap may not be as bad because it is being taxed on the real rate of the return. So I suppose the question that we ask then, well, I suppose, where is the damage? And I think part of the damage is also in terms of the one is the message, and second is the I suppose the view that it has created. Right, it's sort of almost sort of redirecting it against that property investment, and that's sort of the communal the emotion, so to speak. It has a compounding impact. Yeah. The question that I raise, Mike, and the comment that I raise is that all of those budget, your negative gearing and the CGT discount, they're really trying to fix that demand side of the equation. Yeah.
Yep.
And where we unfortunately say that have we seen enough in terms of the work with the supply side of it? And the comment that I say over and over, Australia is such a large country. There is plenty of land, yeah, and some of the lands can be adjusted. What are the incentive that we have seen? Not only giving the supply of the land, but to provide a discount on the supply of the land. And that is where we're working through in terms of the supply. So just one example, I was hearing this gentleman, and the gentleman was giving an example saying, Munzurul, would it not be lovely to have new lands coming in for first-time buyers as an example, but only the first-time buyers gets those new land with, say, 15% as a discount or 20% as a discount, and the construction cost comes in 15 and 20% as a discount. Is that much better because you're working on the supply and you're genuinely giving an incentive, but you're genuinely giving an incentive in a quarantine space where no one else has got the right to artificially increase the price.
So it really changes the risk-adjusted returns for the property investor, depending on how the taxation matter works out. But it has, I think, far-reaching consequences for the economy as well. We talked about international investment, but I was talking to someone the other day about like what is an Australian startup that we actually would love to see more of in Australia. One of the only unicorns of recent years, which is a startup that comes to $1 billion valuation, is a company like Canva. It begs the question, would you start a Canva in Australia today if you had other options? And I'm worried about the answer to that. What do you think?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
I'm genuinely worried about the answer to that as well. And why am I worried about the answer? You know, Australia's interest rate at the moment is one of the highest of the OECD country, and we've unfortunately got government and the rules and regulation, which is creating all those different layer of uncertainties. The tax seems to be increasing that higher. And then we go with the foreign investors, and the foreign investors tax going to be even higher. The foreign residents are buying properties in Australia. We're trying to absolutely capture it out and trying to take all of those benefits even higher as well. And you add away all of those different layers of the combination of the tax and the barrier as such. And it has a far-reaching consequence, absolutely. And Mike, we look back into 1985, and then we sort of say, well, why did we abolish this in 87 and so? And what happened within that period of time, right? And that discussion didn't go through that high. And you and I, we both know that the rents have really gone up. From the builder's point of view, builder started to build less. And that means the supply side of it has stopped. And while the supply side of it has stopped, means that there were more people who are trying to rent because the population growth is natural, is irrespective to what the supply side or tax consequences sort of matter, right? So by doing it this way, the rents were keep increasing, and means that eventually the investors came back. They came back because of the return, not so much in terms of capital growth, but the capital growth followed simply because the investors came back. So by doing it this way, the people who went through the storm, and your example of the sophisticated investors who had got enough buffer to go through the storm, they're the one who received the higher level of the interest rate as well as the higher level of the growth. but the people who lost away along the way are the people that we so desperately trying to help.
And we don't just have 1985 to 1987 as a case study. We can actually look to the globe, and you and I were chatting about this a little while ago. We've got international examples where similar things have been trialled. What can we learn from the rest of the world on these sorts of policies?
Thank you. Brilliant. So we look back into Europe as an example, yeah, and different places in Europe in different period of time, the brand new property and the tax incentive of the brand new property, it's being tried. Exactly same as we are doing it in here. So we're sort of saying that, well, negative gearing is being abolished. Negative gearing is being changed in the way that we can claim the negative gearing, so you don't lose it. The losses gets carried forward to be utilized in future. So the mechanism has changed. The immediate benefit has been taken away. But the brand new properties, the negative gearing sort of continues. So we are giving that incentive to buy the brand new properties here. And what we have found is that when Europe tried to do that a couple of times, is that yes, there was an incentive in terms of buying the brand new properties. And yes, the immediate reaction was there were a number of people who tried to buy the brand new property just to get that immediate sort of the benefit. And very quickly, many of those people realized is that, hang on, we bought it for the tax reason, but is it really right? In terms of our, I suppose, the convenience perspective, in terms of our lifestyle that we are after, and in terms of all the other surrounding matters that we want to be in cafe culture, living near the schools and college and living in there as opposed to living in a very rural area simply because it is a tax incentive brand new property as such. So with this anomaly, when they found is that when they try to sell it, they sort of say, well, it's not a brand new property anymore because I lived in there. So when someone else is trying to buy it, it's an old property. So exactly the reason that I bought is the reason that I don't have it for me to do an exit. So they actually found that the growth on those properties were quite being hampered simply because they bought it with a brand new, with that higher level of demand and arguably with somewhat of level of premium. But when they're selling it, they don't have that as a brand new, and they're selling it in a market where it is being considered with everyone else, right? So because of that strategy, what Europe did, Europe looked back and Europe says that didn't work. It doesn't work. It's all it is doing is to creating even more anomalies, and they have taken away. Yeah. So that, as an example, is a case study that is being done in Europe, is being tested in Europe. It hasn't worked, and we're still trying it in Australia.
Now, one of the things I like most about you, Munzurul, is you're not a politician. So you don't have a say in really what happens and what gets legislated. Of course, you will advise your clients appropriately, but we are at the mercy of Canberra as to what actually happens. Should this be legislated as it's been announced in the budget speech? Obviously, I presume your cogs have been turning really ever since 7:30 on the 12th of May about, well, what are the pathways available? There's lots of people talking about, well, amazingly, superannuation, which was in the news as not being intended as an investment vehicle and needed to change, has not been touched. People are looking at those sorts of avenues. People are talking like buyer's agents about purchasing in commercial structures. Where are some of the areas that we can move and pivot to if this is actually legislated as stated?
Beautiful. Beautiful. What we have seen, Mike, is that over the years is that whenever this legislation changes and you try to close away a pathway, it's only the human nature is that what people try to do is to say, how do we find a way around to it? And it's not so much of having a loophole, but it's sort of more sort of saying, what are the alternate option? And we sort of tend to find a way with the alternate option. And in this example, we will also find alternate option, whether it is self-managed super fund investment as an example, which hasn't been touched at all. Yeah. So your negative gearing and that discount being taken away, it's not being taken away from superannuation fund. Yes, the discount is lesser, which is 1/3, and the tax rate is 15%. So it's just about 5% is the discount, but that 5% makes a difference, and that hasn't been taken away. Yes, the commercial property that all of those tax changes is that they haven't been taken away. So by definition means that your commercial property will improve a bit more in terms of, I suppose, the interest, and the self-managed super fund will improve. Now that's one bit. But the challenge is that the advisors will try to play with the rule and say, how do we change it and direct it back into that sort of the rule? So just before this podcast, you and I, we were speaking, what is the definition of a brand new property under this, the whole legislation? So I've got a house, I'm demolishing the house, I'm building another house in there. Is that a brand new property? Well, the answer is no, right? Under the current understanding. We've got a house that we demolish and we build duplex, then the answer is yes. But we've got a house, we build a granny flat, the answer is no, right? And this rules that are understanding it's coming in is that this will be tested. People will try to test it. What is the definition of a granny flat? If I attach it, is it a granny flat or is it a duplex, right? So all the sort of the anomalies. So in a fanciful way, which is sad, is that it's almost getting the investors to think outside the square quite a bit, which is, and then you sort of say, does that create more anomalies within the economy in terms of finding a way as opposed to having a defined rule?
One thing I wanted to ask you about is broader reaching unintended consequences. Of course, we talked about the economic consequences across the country, but if we look back to the last census, around 27% of the full-time working population were in and around property and property services. I wonder if we aren't able to get these negative gearing allowances, what is the incentive for people to make renovations, do repairs and maintenance? We still haven't necessarily seen how that's treated in the budget. What do you think is likely to happen, and what will property look like if we fast forward to May 2028, this is legislated and Labor win that election as well?
Part of the question is one answer, and part of the question is very difficult, right? And the portion is very difficult. What does it mean in 2028? And there is all likelihood, whatever I say, in 2028, we'll look back and say that, well, Munzurul had 50% chance of getting it right, and the 50% chance is wrong. So I'll have a shot with a 50% chance of getting it right in 2028. But the other part of it, when you say that it's a consequence, is a really good question, Mike. And the reason I said it's a really good question, because there is a multiplier impact to it. Yeah, we're speaking quite heavily about the property investors, but of course it's not only the property investors, right? It's the builders and the real estate agents and the renovators, right? Everyone else who works around that sort of the entire real estate agents as such, right? That all the sort of suppliers, your plumbers and your sort of kitchenette and your sort of, those handyman, every one of those roles has an impact in various ways. We look into the unemployment rate and we say that, well, we've been very lucky so far. Yes, we've done well as an economy. We've been very lucky. We were sitting at 4.3. Now we've gone up to 4.5. Is 4.5 to be really being concerned of as at May 26? Probably not, but it's not definitely on the right direction. And if you look into the wage growth is sitting about 3.6% as at now in May 2026. Well, what does that mean? Well, the inflation is 4.6. So if the inflation is 4.6, you've got a wage growth which is lesser than inflation, means we are having a wage decrease. So we are not in a very strong position to start with at the moment. Yes, we understand whether it is the external war, whether it is various reasons, some of those things may be beyond our control, we get it. But this whole budget as sort of double and the triple whammy, so to speak, it came in at a point of time that we were already being weakened by various hit, which are beyond our control. And this just has given us further hit. So I agree with that. Yeah. Why do we see in 2028? I think my view, and again, with the disclaimer, 50% chance of getting it right and wrong. So my view is that you almost have panic of two-step. So you've got that initial level of the panic and sort of overreaction is that when the budget comes in, everyone sort of runs around, particularly the younger investors without sort of much of the experience. It's the world has collapsed, and they straight away say, do I sell it? Do I sell it before June 2027? Do I need to go back and restructure my structure? I'm going to change it, and I'm not going to buy anything on trust. I'm going to buy any corporate entity. All those decisions they try to make, yeah, day one. Then things start to get a bit more settled until the legislation come in, we understand. And so as soon as the legislation all comes in, there is a second hit. So you've got that first dip in terms of the sentiment and the price decrease. Then whether it stabilizes for a very short period of time, you almost get a second dip again when the legislation comes in and we say, oh, good Lord, it is final now. So there is no ambiguity. Now we understand it's on the law. This is where you sort of say that there's that decline in the prices, that it stays on that decline for a good period of time, but the rents are keep increasing. So the rents sort of keep increasing, but the price, what it dropped, it sort of dropped it at a point of time. So what I see in May 2028, unfortunately, Mike, I would be very surprised if the rents are not significantly higher than where it is right now. We already are sitting in many places of less than 2% of the vacancy rate. And anything below 3% means that it's a tough market. Below 2%, we are in chronic shortage here. And we already sitting different places below 2%, and that rent will significantly increase. Do I really see prices increasing quite a bit between now till 2028? Well, within 2 years, prices will drop a bit, stabilize a bit, and we may just see the early sign to medium sign of the prices to catch up.
I had this conversation earlier today with somebody about Treasury's prediction, which obviously you have taken issue with the statement that you just made. $2 a week median increase in rents is the net result. Now, they've been a bit cagey on this. They've sort of said it will only go up by an extra $2 on top of what it's already going up, right? Because we have a rental crisis with very, very low, like 1.3% vacancy rates. Where do they get that information from? I mean, I'm asking you to answer on behalf of Treasury. You're not a politician. You're dressed like right now you could probably get a job in Treasury tomorrow, Munzurul, but I think you're reading off a different hymn sheet.
But even though we do the maths and we sort of say, what's the median rent in Australia? Then we sort of say, well, what does $2 means as a percentage of a median rent in Australia? And very quickly we sort of say, hang on, that doesn't make sense. So your $2 on the median rent in Australia, I really genuinely struggle to understand. Then I'll give you my practical example. I'll give you a couple of suburbs. My properties, I perhaps can name the suburb. I was increasing a couple of my rental property in Campbelltown area. I was increasing a couple of my rental property into the Logan and the Ipswich area. In Brisbane, I was increasing a couple of my rental properties in Melbourne into Sunshine, St. Albans, and some of those sort of an area. And in New South Wales and in Brisbane in particular, Redcliffe as an example, that it's a very simple property that I was looking through the rent. It's about 545 and it was literally just 1 year ago, right? And I looked into the market and I was like, there is not a single property of below 650 of that level of property. And by looking into the property, it should be around 660, 670. And I was like, how do I increase a rent from 545 to 660? But that's what the market is telling me. That is what the rent is. Now, whether it's 545 to 660 or whether it is $20 less, 640 or 630, still seems to be much far than $2 increase.
Yes, I'm not a mathematician, but I think we've debunked that particular one. Now, for the people that are playing at home that are thinking of purchasing property because their strategy is bigger than the policy settings. And as you mentioned in the beginning, you don't buy property because of a tax setting. That's not the strategy. That's the bonus, right? Like I always say about tax depreciation, you never buy a property because of the deductions. That's just a bonus. And the asset has to do the heavy lifting. What do you say to people that are a little bit concerned right now? They want to take control of their financial future. They want to do what most property investors want to do, which is de-qualify themselves from the age pension because they've taken control of their life. What advice would you have for those people?
Excellent. Excellent. Brilliant. Thank you. The first comment which I'll say, not to panic, not to make a rash decision, and you don't need to go around and change everything that you've been doing it for last that many years. First comment. Second comment which I say is that wait it out a bit to completely understand what the legislation it would be coming through. So it gets documented, we understand it, we read it, we study it. Third, once you wait it out a bit, once you go through the legislation and you understand all of those, then ideally sit down with your advisor. Sit down with your financial planner, sit down with your accountant, sit down with your professional advisor that you sit down with your buyer's agency, however way it is, right? And you sort of say that where to. Now, in terms of that where to, we must, in my view, without giving financial advice, look back into the longer term goal. That hasn't changed. What is your longer term goal in terms of your investment, in terms of your retirement? That hasn't changed. Tax has created a bit of an anomaly, but that hasn't changed. And then you make a decision, my view, on the basis of the advisor on your particular circumstances. And the reason I say this is that if I have I've got three different couple of property investors. Couple one, who are early to mid 30s, couple two, who is sort of mid 40s, and couple three, who are sort of late 50s. Yeah. And they all have some property portfolio. When they sit down with their advisors, their advice could very well be different on the basis of their age bracket, closer to the retirement, further away from retirement, based on their wealth, based on their risk profile, based on their liquidity, and based on many, many, many other things. So not to make a rushed decision, but it is absolutely prudent, in my view, is that when everything gets settled, dust settles, is that you sit down and make a very informed and pragmatic decision with long term in your mind.
I love that calm, considered advice that you've built your reputation on, Munzurul, and I look forward to getting you back in when the dust settles and we see what sort of dumpster fire we might be working with. But hopefully we see some moderation and some walkbacks in meaningful ways. But thank you very much for joining me today.
Thank you very much. Thank you, Mike. Thank you for having me, myself. Thank you.